What's up, you guys? It's Simon with Simon Says Finance, where on my channel I hope to share with you some key financial topics that are going to help you become more knowledgeable and confident in handling your own personal finances. So for today's episode, we're going to discuss the difference between the 401k and the Roth IRA and determining which one is better for you in your particular situation. So I know talking about the 401k and Roth IRA may not be the sexiest topic to talk about, but bear with me until the end so we can determine which one's better for you. Because understanding the differences between the two can help you save hundreds of thousands of dollars upon retirement just from watching this video. So how I'm going to start off this video is by highlighting some of the key differences between the 401k and the Roth IRA. That way you get a bird's eye view of how these two things work. And then at the end of this video, I'm going to put a couple examples to help you to determine and put all this knowledge together so you can figure out which one of these vehicles is best for you. And if at any time throughout this video you have any questions or concerns, make sure to comment down below and I'll be more than happy to help you out. And just as a quick disclaimer,
I'm not a financial advisor, I'm just some guy on YouTube giving his opinion on some financial topics, and it's up to you to determine what is best for your own personal finances.
now with all that said, let's get started. So as you can see from this chart, I own both the 401k and the Roth IRA. Although both of these vehicles are used for retirement, they both have some distinct differences which we will go over one by one. So for the 401k, this is an employment-sponsored retirement plan. What this means is that you have to be working at a location that offers this plan, otherwise you won't be able to get the 401k option. What this also means is that since it's sponsored by your employer, oftentimes they offer an employer match, where they pretty much give you free money for every dollar you contribute. This is by far the most powerful thing that the 401k has that the Roth does not, because if an employer matches you, automatically you make 100% return on investment, which not even Warren Buffett can beat that on a year-to-year basis. Now for the Roth, it is not employer sponsored, and because of that, anyone can pretty much get a Roth, and you don't have to work at any particular company in order to get a Roth. But because it isn't sponsored by anyone, there is no match from anyone because no one is trying to give you an incentive for you to save money for your retirement. Now for the next row, any contributions made into a 401k are tax deductible from your income on the year you contribute. So what this means is if you make $100,000 this year and you contribute $15,000 into your 401k, your taxable earnings for the year is now $85,000. So instead of paying taxes on the $100,000, you'll be paying taxes on the $85,000, thus saving you money on taxes for that year. But these taxes aren't gone, they're just deferred to a later time, which means you're just going to be paying for them later in the future. But we will discuss more on that later. Now for the Roth IRA, you will be paying taxes on the contribution. So if you made $100,000 that year and you contributed $5,000, your taxable income for that year is still $100,000. However, after you pay those taxes, you never have to pay them again in the future. So the way I like to remember this row is think of the word Roth as in right now. So a Roth IRA, I am paying taxes right now, and a 401k, I'm paying taxes in the future. It's kind of a nerdy way to think about it, but it works. Now for the next column, both of these investment vehicles are the same in that you can begin withdrawing from both your 401k and the Roth IRA at age 59.5 with no penalty. But in the next column, we have a difference in how these vehicles are taxed when it comes time to retirement. In the 401k, all withdrawals are taxed at the income tax rate that you're in at the time of retirement. While the Roth IRA, since you already pay taxes on this money when you first contributed it, you don't have to pay taxes again once you pull it out for retirement. So now let's show you an example of how you can utilize these differences to your advantage. According to the Bureau of Labor Statistics, the average retiree today makes $48,000 a year before taxes with all the retirement streams of income, like Social Security, pension, retirement income, and other side jobs, etc. So depending on where you live, this may or may not be enough, but we are going to use this number since this is the truth data and this is what's happening today in the US. But let's round it up to $50,000 to make it a nice round number so that we can use it when we compare. So assuming we keep the same tax brackets, for a single tax filer that makes under $50,000 a year, we will be paying somewhere between 0 and 22% in taxes. While if we make over $50,000 a year, you'll be paying somewhere between 22 to 37%. So now let's say you're a young cat, you just turned 18 and maybe got your first part-time job, or you just started college and you make $10,000 a year. In this situation, when you take into account where the average retiree is in terms of tax brackets and where you are now, I would say it's better to invest in a Roth IRA since you are only paying 12%, while if you're retiring making $50,000 a year, you'll be in the 22% tax bracket. So it would be smarter for you to bite the bullet now and pay the taxes up front in a Roth IRA where you're in a smaller tax bracket as opposed to waiting to retirement when you're in a higher tax bracket. But now let's say you're a rare superstar and you're making $550,000 a year, but you don't know how long it really is going to last making this kind of money. But you know that when you retire, the average person is going to fall close to around the $50,000 a year income. In this situation, you'd want to consider taking the tax deduction now with the 401k because you will be in a 37% tax bracket anticipating you'll be in the 22 to 24% tax bracket in the future when you retire at a lower yearly income. So with these two examples, I hope it gives you a basic understanding of which vehicles best fits your life depending on your current taxable income. Now for the next row of this chart, shows the contribution limits for both vehicles. The 401k allows you to contribute up to $20,500 a year, not including any employer matches, as of 2022. Now for the Roth IRA, there is a contribution limit depending on your age. If you're under 50 years old, you can contribute $6,000 a year. And if you're over 50 years old, the government allows you to contribute an additional $1,000 per year to help you catch up for a total of $7,000 a year. So this is the reason why if you're doing a Roth IRA, you want to maximize the contribution as young as you can, because you're limited by how much you can put in per year. And once that year has passed, you missed out on that $6,000 to $7,000 that you could have grown and withdrawn tax-free in the future. Now the next row describes what happens when you take out money before the age of 59.5. So for the 401k, if you take out any of the money, whether it's the money you contributed or the money that was gained from the profits, you'll be paying not only taxes at normal income tax rates, but also an additional 10% penalty on any money you take out. But for the Roth, these penalties are similar, but only for the profits you made. You can still take out the original contributions at any time, all penalty-free and tax-free, since you already pay taxes on this money. It is a great feature for the Roth IRA, since in the event an unforeseen emergency happened to you and you wanted to have access to your money without any penalties, you can do so with the Roth IRA. So now an example to show these differences. Say for the years of 2014 to the year 2022, you contributed $6,000 a year into both the 401k and the Roth IRA. In 2022, you are 30 years old and you make $100,000 a year income. So each vehicle has 9 times $6,000, which is a total of $54,000. Now say both of these investment vehicles grew to $100,000 each over the years, which means each of these have $54,000 in principal contribution and $46,000 in gains. So say an emergency happened to you and you needed $54,000 to pay for something quickly. If you took it out of the 401k, since you make $100,000 that year, you'll be taxed at a 24% tax bracket for that money, in addition to any of the other federal taxes for that year. And since you're under the age of 59.5, you incur an additional 10% penalty on that money you took out. Thus, if you look at the screenshot from an early retirement withdrawal calculator, you'll be charged a total of $15,120 in taxes and an additional $5,400 in penalties, thus resulting from the $54,000 that you wanted to withdraw only equaling to $33,480 to you because you paid $20,520 in taxes and penalties. Now, on the other hand, if you had tried to withdraw that same $54,000 from a Roth IRA, you would get the entire $54,000 because it's money you already paid taxes on when you contributed. And you won't get any additional penalties as long as you don't take any of the profits made while the money was in the account. So like I mentioned before, the Roth IRA can be a great investment vehicle in an event that you need the access to your money now and don't want to pay any additional fees for early withdrawal. Now for the next row of this chart, there's a difference in terms of the forced minimum withdrawal amount being placed on the 401k after the age of 70.5, while for the Roth IRA, there is no minimum withdrawal amount. So what this means is that after the age of 70.5, if you have any money in the 401k, you have to start taking money out and pay taxes on that amount, whether you need it or not. But for the Roth IRA, you can potentially leave that money in that account to grow forever, and you never have to take it out if you don't want to. So you can just keep it in there and let it keep growing for the rest of your life. And because of this, the Roth IRA is a great estate planning tool because you can pass it to your heirs so they can benefit from having all this money tax-free to use when you die. So now for the next row is another key difference between the 401k and the Roth IRA, in that you are more limited by the 401k because you can only really invest in what your employer offers to you. What this means is if you wanted to invest in, say, Tesla stock, you couldn't invest in that in your 401k unless your employer offers that as an option. But in your Roth IRA, if you wanted to invest in individual stock, you could do so at your own choosing. In addition to the Roth IRA, there's a whole other topic that's out of the scope of this vehicle where you can invest the money in your Roth IRA into what's called a self-directed Roth IRA so that you can invest in things such as cryptocurrencies, real estate, and other things that are outside of stocks and allow them to grow tax-free. But that's a topic for another video. And that's it, you guys, on this video on comparing the difference between the 401k and the Roth IRA. If you got any value from this video, make sure to hit the thumbs up button and comment down below any additional questions you have on any of these vehicles. And if you want to see more of these kind of videos, make sure to hit that subscribe button and hit that notification bell. That way you don't miss out on our next video. And if you're a person that has a 401k or a Roth IRA or both, feel free to comment down below your experience in each of these and how you manage and decide which is best for you. And with that, you guys, this video is my 2 cents that I invest in you, and I hope it continues to compound until we're all financially free. So until next time, guys, Simon says, do as I say, and have a great day. Thank you.